Hello.
In 1948, Hamas started with a simple intent to make healthful living happen across the communities we serve. For over 7 decades, we have sought to offer world-class, affordable consumer products, medicines, healthcare, and mobility solutions. Across our consumer brands, Hamas is a leader in most categories in which we are present. Our hair oil brand is a market leader in Bangladesh. Hamas has always sought to be at the forefront of delivering best-in-class healthcare and medicines. We are the leading importer and distributor of medicines at private retail. Through our EU GMP-compliant pharmaceutical plant, we are the largest manufacturer of oral solid dosage forms of medicines in the country. Hamas Hospital is a growing hospitals and laboratory chain, providing affordable healthcare to the emerging middle-income customer. We have always believed in the potential of the next generation and have worked towards creating an inclusive world where no child is left behind. Our focus has always been to ensure that the needs of the communities across our nation are met. At Hamas, we believe that every Sri Lankan deserves a better tomorrow, to live a life filled with daily moments of joy and, most importantly, an opportunity to thrive and grow. In our onward journey, we will continue to invest in diverse and passionate teams, create meaningful offerings, champion a more inclusive world, and positively impact all our stakeholders. Hamas, making healthful living happen for over 7 decades.
In every endeavor, there's a North Star that shines a light on its path to success. Each milestone is greater than the one which precedes it. The beacon that illuminates our journey and steers our vision of the future is family. We are a dynamic family of professionals, connecting multiple industries on a global scale. At Sri Lanka Vacations, we are an internationally trusted travel partner, excelling in MICE tourism. Curating unforgettable memories is what we do. We believe that for truly inspired experiences to take place, they should be sought in equally stirring destinations. And that's where we at Sri Lanka Vacations are geared to assist you. Prudential Shipping is where we set sail on our mission of providing an extensive range of maritime services. We offer our expertise in full vessel agency services, freight forwarding, offshore logistics, ship-to-ship operations, and NVOCC agency services. We don't stop there. We are also moving some of the world's most valuable cargo across continents, thanks to our strategic and technically savvy team at Premium Trading and Logistics. We deliver rapid solutions via sea, air, and land, with trading, customs house brokerage, ship chandling, haulage, and warehousing facilities. We are a resolute and future-ready corporate family, with a global network spearheading solutions that empower you to achieve your goals. As we celebrate 25 years of being an essential cog in the machine that's driving many global ventures, we are geared to meet the diverse challenges of tomorrow head on, together with you. We are Mendis One.
Ceylon Bank. Every step you take, we'll be there by your side. Today, tomorrow, and for days to come. Ceylon Bank, the bank with a heart.
Good evening, everyone, and thank you for logging in. Today's webinar is organized by the Ceylon Chamber of Commerce, and it's on the topic of understanding the new VAT Amendment Bill, key insights and business implications. So today we have our moderator, Mr. Sulaiman Ishran, who's the partner tax at Ernst & Young, and our guest speaker, Mr. Suresh Pereira, principal of the Tax and Regulatory Division, KPMG Sri Lanka. Over to you, Sulaiman. And if any of the participants have any questions, please be kind to use the chat. Over to you.
Thanks, Sanjay. Good afternoon, ladies and gentlemen, and thank you for joining this webinar organized by the Chamber. Actually, it came from the Taxation Committee, where there was a bill that was passed quite suddenly, rather not passed, but presented, gazetted on effective August 31st. So to amend the VAT law. So as you know, prior to amending a law, the bill is gazetted and put out to public, and public is able to take up any issues either via the court process or via committee stage amendments, which I think Suresh will go into a bit of depth on the process. And subsequent to that, it is sort of read in Parliament, debated, and then passed. And only once it's passed and certified by the speaker does it become law. So it's currently in the process of being taken up in Parliament and passed. It hasn't been passed yet. So the main theme of this is basically, as you would have heard, the abolishment of the SVAT scheme was one of the major proposals or major proposed amendments in this bill. Which I think the cabinet has given the nod to extend the abolishment until 2025 April 1st on the positive side, thereby assisting the exporters. And the other salient feature in this is a plethora of exemptions have been removed. So many industries that were exempt from VAT, those exemptions have been removed. And what we hope to do is take you through some of those salient features, what exemptions are being removed, so that you are aware of it, as well as what sort of implications it would have to you being someone who supplies those goods and services that are exempt, and now you're going to become liable, what you need to look out for, as well as if some of your inputs were in fact exempt and now are going to be liable, how you should sort of deal with it. So the urgency of this is because the way it is drafted, it says that the exemption removal will come into effect on the first day of the month after it is passed in Parliament. So if, for example, it's passed in October, all these exemptions will be removed from November 1st, and hence the urgency and significance for you to be aware of what these changes are. So I'll invite, I think Suresh needs no introduction. He's principal of KPMG Tax and Regulatory. May I request Suresh to take us through what these major changes are. Over to you, Suresh.
Yeah, thank you, Suleiman. I have a set of slides. I will share that, and then we'll go through the changes. Hope you can see the slides.
I can see, yes.
Right, and I hope my voice is clear.
Yes,
right.
Clear.
So what we're going to do during the next maybe 1 hour or so is to dissect this VAT Amendment Bill 2023. Like Suleiman rightly pointed out, this bill, there are 3 main functions, basically to abolish the SVAT. But now with the cabinet deciding to postpone that, I think that's not the most urgent aspect in this bill, but with regard to discuss and come to an understanding exactly what is happening with regard to the other main focus of this bill, that is to streamline the VAT exemptions that are there. And of course, there is another area also addressed in this bill. I believe that is within connection, that is in connection with the move to abolish the SVAT scheme, that is basically to increase the amount of remittances that are made by the Director General of Customs to the VAT refund fund. Right now, basically 6% of the VAT collected by the Director General of Customs is being remitted to the VAT refund fund, and that percentage is to be increased to 10%. Right. So basically, these are the 3 areas. So what we will do is in this one, we will actually focus more on the streamlining of the VAT exemptions. But prior to that, let me speak a little bit with regard to the abolition of the SVAT. So as we all know, SVAT was introduced somewhere in 2011 in Sri Lanka, and it basically addressed the issue of build-up of the VAT refunds and the delays and the sufferings of the taxpayers with regard to the inefficiency in processing the VAT refunds, and as a result, most of the exporters and other parties were basically suffering, and their VAT refunds were at the Indian Revenue Department. So to address that one, a homegrown system called SVAT was introduced, and we have all witnessed that. Well, it's a unique system to Sri Lanka, but somehow, okay, it has its how do I say, the positive points as well as the minus points, but at the same time, it has addressed the main issue of the VAT refunds, delays in processing the VAT refunds, and the inconveniences suffered by the taxpayers, specifically the exporters. So somehow there has been a school of thought that it should not be in our VAT system, and because of that, I understand basically there has been representation to the IMF, and the IMF when they issued a report somewhere in March 2023 in relation to the extended fund facility, suggested that the VAT refund system to be abolished with effect from 1st of January 2024. So this is the exact extract from the annexure from the IMF report that I have shown. So, so as a result, to abolish the SVAT scheme and to streamline the VAT exemptions, this specific bill has been issued. Normally what we see is, what we witness is, after a budget, we see the amendments being introduced, but here this time of the year, before the budget also, this has come. That is because of the timeline given by the IMF, which is 1st of January 2024 for the implementation of the 2 major VAT amendments to the VAT Act in Sri Lanka. So out of that, the SVAT one now has been postponed. And so I think, as I mentioned earlier, what we need to focus is with regard to the VAT exemptions. Now, what about the fate, or where does this bill, where is this bill right now? I think the bill was issued on the 31st of August, and according to the process, before it is being once it's being placed in the order paper of the Parliament. There is a timeline given for anyone who is interested in challenging in the Supreme Court for it to be challenged. And accordingly, we see that this bill has been challenged, and hearings happened on 25th and the 26th, but still the determination of the Supreme Court has not been delivered and presented in the Parliament. So that is where it is. And once it is presented in the Parliament, the depending on the outcome, the parliamentary process will stand. So that's basically the first reading, second reading, the committee stage amendments, and the third reading and the vote and the certification by the Speaker will take place for this to be enacted as law in the Parliament. Now, this main issue, the addressing the VAT exemptions, actually was proposed in the budget speech 2023 also. You can see I've extracted this from the budget speech that this happened before the IMF report also. So it read, fraud estimates suggest that the revenue foregone due to the VAT exemptions generated to various sectors, VAT exemption granted to various sectors, including electricity, transport, and fuel, is estimated to be more than 1% of the GDP. Hence, it is proposed to remove certain exemptions after reviewing. Amendments to VAT Act to remove certain exemptions will be made effective 1st April 2023. So there was a deadline also that was mentioned in the budget speech to remove VAT exemptions, but somehow at that time, no measures were taken to eliminate the VAT refund. So it's now that we see that process. So as we all know, basically there was a major surgery to the Sri Lankan tax regime, including the VAT regime, and as a result, number of VAT registrants reduced significantly. You can see from 2019, the number of VAT registrants had gone down in Sri Lanka. So in order to increase the VAT base, two measures were taken, and in a recent amendment bill, as you can recall, the threshold, which was increased from 12 million per annum to 300 million in 2019, has been reduced to 80 million. So that is the first measure that has been taken by the Parliament, by the legislature, to increase the VAT base in Sri Lanka. And it's the second measure that we find, the streamlining of VAT exemptions that is included in the VAT bill now. Right. So what is happening here? If you take a count of the number of exemptions, VAT exemptions that are in the VAT Act, we can see roughly around 300 exemptions are there. And out of the 300 exemptions, after the streamlining takes place, we can see only about 50 exemptions will remain. So we can see almost 80% of the existing exemptions are to be removed under this bill. So I'm sure most of the taxpayers would not like the idea of basically VAT exemptions being taken out, but from a practical perspective, if the VAT is to be effective in Sri Lanka, if it is to achieve its purpose, then this large number of VAT exemptions are acting as a barrier. So for VAT to be effective in a country, that means if the value addition in the economy is to be taxed as a tool for collecting indirect taxes as opposed to taxing the turnover, then VAT should be applicable on all the major industries in the economy, not just few. Moment you increase the number of exemptions, that results in the VAT system being distorted. So that is given. So therefore, we all agree, I'm sure most of us will agree, that removal of the VAT exemptions is the correct decision. Having said that, then one would have to ask the question, is the process that is being used to eliminate the VAT exemptions from the Act, is that correct? Is that being carried out in the best interest of the economy, best interest of all the stakeholders? Right. To me, basically, removal of 80% of the exemptions without phasing out the removal of the exemptions one shot will have a shock in relation to the economy, because I expect that there will be a price increase of the goods and the supplies, goods and the services in the marketplace, and that will result in the stakeholders, the consumers, having to pay high prices for the goods and the services. Right, now let me go into detail with regard to this, why this will happen. Now, what is going to happen is from the date of the surgery, from the date of the elimination of the VAT, what we are going to see is a non-taxable activity is going to become a taxable activity. So during the initial taxable period, let's say the first taxable period, most of the taxpayers will not have any input credit to be claimed. So for that to be effective, what is that? That is the tax on the value addition. So now when there is no input credit to be claimed in the initial period of the conversion, the the rate will be applicable on the price of the good or the service. So in other words, it's going to act like a turnover tax because there is no input to be claimed. So it's not going to be a tax on the value addition during the first taxable period, but it's more likely than not, it's going to be a turnover tax. So that's going to result in the prices increasing abnormally also. Now, when a person is doing the costing, when the accountant of the company is doing the costing, he will be doing the costing without taking into consideration the input VAT availability in the future. So naturally, the prices that he will compute to be sold at the marketplace will be high. And thereafter, in the subsequent taxable periods, when the input VAT is also made available, once the prices are set at a particular point, it's very unlikely those prices will be brought down subsequently when the input VAT is available. So because of that, also there will be a price increase in the market, in addition to the real impact of the VAT imposition also in relation to these activities which are right now exempt. And then also we will also witness not all the taxpayers will be able to claim input VAT even in subsequent years with regard to the stocks that they have. Let's take the case of residential accommodation providers. Say the people who are selling houses, villas which are not condominium units, they will not have any input to claim, and their stocks will not be supplied during the first or the initial taxable period also. And because of that, there is going to be a inconvenience or with regard to their supplies and their calculation of their prices also. And also we need to be mindful, some of the suppliers in the marketplace will be blaming the VAT increase and increasing the prices of their goods and services disproportionately to the increase of the imposition of the VAT on their supplies. So in other words, they will be making secret profits, and it's a very common practice. We call this profiteering. So when the suppliers start making profiteering also, in addition to the normal VAT, due to the normal price increase that we can expect due to the imposition of the VAT, there will be additional price increases also. So basically, this 80% withdrawal of the exemptions from the total exemption list, I think basically we can reasonably expect that there will be a price increase in the marketplace. And this will not be the case if we try to phase out the VAT exemptions in phases. So that's something that the policymakers have to be mindful. And also, again, we have to ask the question, are there any other alternatives if we are trying to do this thing? Is the answer to provide advance facility to register or to register in advance as a facility for these categories, for them to build up their input VAT, so that when they start making the taxable supplies, that they will have sufficient input to deduct, so that there will not be abnormal price increases in the market. Another technique, I don't know, basically what the policymakers should consider is whether when you are converting a non-taxable activity to a taxable activity, whether it should be done in one stage like that, or they should consider doing it in 2 stages. That is basically first to make the non-taxable activity 0 status. So that means basically it becomes taxable, but there's no output VAT, but at the same time they can claim the input VAT. And thereafter the 0 status activities to be converted into taxable activity, so that they start making output supplies, output VAT, and against the output VAT they can deduct the input VAT. Therefore, the gradually the value addition gets taxed. Maybe a technique the policymakers should consider. Another technique the policymakers can consider is to prevent this additional, this abnormal prices in the marketplace because of this 80% elimination of the exemptions, of the total exemptions. Whether they should create what are called deemed input credit, artificial or deemed input credit. And this technique was used in the past to ensure that there will be input credit available, so that there will not be pressure on the prices of the goods and the supplies. So it's another technique that the policymakers should consider. I don't know if it's too late, but this, if the policymakers are conscious with regard to the price increase in the marketplace, those are things that should be considered. Then, of course, policymakers should also be mindful that there's sufficient time for the companies to change their computer systems, software systems, to modify their system, to prepare for this sudden change. Right. Now, this is the section 22, subsection 14 that was there earlier in the Act, which was removed in the recent past with regard to facilitating suppliers to claim deemed input credit, where basically a non-taxable activity, an exempt activity becoming liable to ensure there is artificial reduction is given as input credit to ensure there is no, how do I say, price increase in the market. Right. Now, this is another interesting question. What is the effective date of the removal of the exemptions? Right. Now, let's analyze this one. It does not seem, it's sometimes, okay, we understand it in one way, but at the same time, when we start analyzing it in detail, we can see there's another hidden effect also. Right. Now, what we have to see is basically the existing 300 list of exemptions are included in the first schedule, part 2 of the Act. So what is happening here is not the first schedule of the part 2 Act being amended. What is happening, in fact, is first schedule of the part 2 is being how do I say, is being eliminated, or basically a full stop is being put to the part 2 of the Act, and a new schedule called first schedule part 3 is being introduced. So the new exemptions, the 50 new exemptions that are being retained, are included into a new list. So existing list is not being amended. So how the existing list is being closed down, cessation, and how the new list is being operated, become operative, is important to understand. What will be the date on which this exemptions will cease, and how it will, how the new exemptions will commence, and what will be the exact effective date. Right now, let me take you through this one. So now, when we what we can see is, like Suleiman rightly pointed out, the wording in the Act with regard to the closing the existing list of exemptions, the 300 exemptions, the wording used in the draft is this: for any taxable period commencing on or after 1st January 2004, what is within the brackets not relevant, but what is underlined is important, ending on or before the last day of the month in which the bill becomes an Act of Parliament. Ending on or before the last day of the month. So, like Suleiman pointed out, if the VAT bill hypothetically certified by the Speaker, say on the 15th of October 2023, then the existing list of 300 gets eliminated, ceases to operate from 31st October 2023. So last day of the month. So that's how the wording has been provided to ensure the existing list of exemptions come to an end. So that is the first schedule, part 2. And then how does the part 3 commence? Now this is the important one. Now you can see the wording used with regard to commencement of the list of exemptions, the new list of exemptions in the part 3 is affected by this wording that I reproduced here. And it says for any taxable period commencing on or after the first day of the month, immediately succeeding the month in which the bill becomes an act of parliament. Right. So what we are looking at here is what the legislature has done is they are referring to for any taxable period commencing on or after the first day of the month, immediately succeeding the month in which the bill becomes an act of parliament. So taxable period commencing. So what is taxable period? Now, as we all know, there are 2 taxable periods. There are, let's say, the at present the RIPs, the normally the zero-rated suppliers, registered identified purchasers, the exporters. Their taxable period is 1 month, and there's the most of the others basically are 3 months. So we have 2 taxable periods. Now the way this law has been worded in relation to the taxable period, where the taxable period is 1 month, it works smoothly. So in other words, if the speaker signs the act on the 15th of October 2023, the existing list will come to an end on the 31st of October 2023, and the new list will commence from the 1st of November itself. So there is no, how to say, it's smooth, the migration is very smooth. But on the other hand, in case of the category of taxpayers, where they follow a 3 months taxable period, there is going to be a gap. Now let me explain again. So there what happens is, there 15th of October 2023, the existing, the speaker signs off, and on the 31st October, the list, the current exemption list comes to an end. But when does the new list becomes operative for the persons who are following 3 months taxable period? You see, for any taxable period commencing on or after the first day of the month, immediately succeeding the month in which the bill becomes an act of parliament. For the 3 month taxable period category, their taxable period will commence now from the 1st of January. So what's going to happen is the 50 exemptions that are there will become operative for them from the 1st of January. If the speaker happens to sign this on the 15th of October 2023, not on the 1st of November, because there is no taxable period. The 3 month taxable period is not commencing on the 1st of November. It's commencing on the 1st of January. So what happens is, for them, we will see that month of November and during the month of December, there are no exemptions whatsoever. All the supplies that they make, even if they fall within the 50 category, they will have to pay VAT, because the new list has not become operative for them, because their taxable period commences on the 1st of January. So this is basically, I think, drafting, the oversight in relation to the drafting. So the intention is not that. So the intention has to reflect the intention. The drafting has to change at the committee stage time. So if I go through this again, so the certification of the speaker is on the 15th of October, and the current exemptions part 2 ceases on the 31st October. I'm talking in the 3 month taxable period category, right? The new 50 exemptions commence from the 1st January 2024. So they won't have any exemptions during the November and December, even for the 50 exemption to be retained. So if now this situation will happen even if the certification by the speaker happens, let's say, in the month of November. How this transition will take place smoothly is if the certification of the speaker is executed, is signed off only in the month of December. So if the speaker signs the act in the December, yes, for both categories of taxable periods, 1 month and the 3 months, then the new list will be effective from 1st of January. So on the other hand, okay, for due to any delay, if this wording continues and the speaker happens to sign off not in December, but in January or February, again, this gap will arise. So there are two things that can happen. Either a committee stage amendment has to be introduced, should be introduced to ensure that this gap will not occur, or somehow the administrators must ensure signing of the act by the speaker should happen in December. It should not happen in the month of November. It should not happen in the month of October. And so that's an important one. So this is with regard to the supplies to be made. 3 months supplies made by taxpayers who are following the 3 months taxable period. Now, what will be the impact with regard to the imports? Now, this anomaly will affect the imports also. Now, we may have the situation where the Director General, let's say if the act is signed off by the speaker on the 15th of October, the exemptions come to an end on the 31st of October, and with regard to the importers who are following the 3-month taxable period, strictly speaking, they are not entitled for the VAT exemptions in month of November and the December. So in other words, the Director General Customs will have to analyze and see, okay, is the importer following a 1-month taxable period or 3 months taxable period, and according to decide whether to impose VAT or not. So this it's messy. So that can't happen in practice. Therefore, basically, either the committee stage amendment should address this issue or ensure that the speaker signs off only in December, right? So that's a major. So now, once this, in anticipation of this, now, as the accountant working in the firm, as the financial person working in the firm, what are the things that you all will have to be mindful of? Assuming this hiccup is basically addressed in a different way, right? So the action plan. I think the accountant of the firm will have to do the costing of the products in relation to the change that is to be witnessed. That is basically the taxable activity, the taxable the exempt supply or the exempt supply of good or the service provided by supplied by the company becoming liable. So they'll have to do the costing and decide what the new price to be charged, and they'll have to look at the cash flow planning, and of course then go for VAT registration, make the applications and obtain the VAT registration. Then of course look at modifying the software system and take account of be mindful with regard to related cost involved in modification of the software system, better to modify or to buy a new system, etc. Then of course make arrangements to issue VAT invoices going forward, maintain the records, and then of course the collection of information required for VAT payment computation, that is to ensure input VAT schedules, output VAT schedules, debit notes where needed, credit notes, etc. And all this, and the entire VAT system should be implemented within the organization. So those are the challenges that come when you are basically moving from non-taxable activity to a taxable activity. So things that you all will have to be mindful to implement in the organization. And also we have to keep in mind VAT is not a simple system, and you need to be comply with the compliance requirements. And if the compliance requirements are not adhered to according to the law, then there are penalties also. So in a snapshot, what are the penalties that are there? If a person fails to issue the VAT invoice, there's a penalty of 25,000 plus 500 per day. Thereafter, to a maximum of 2.5 lakhs, where the non-compliance continues, that is in relation to failure to issue VAT invoices. And if the party fails to furnish the VAT return, lodge the VAT returns on due date, you can see there's a 50% penalty or even the imprisonment up to 6 months. And if a person is guilty of an offense, again you can see the the procedure that is you could be prosecuted even in the magistrate court, and the penalties that are there. So all those companies that are moving from exempt status to the liable status, we have to be mindful that about these penalties as well, and to be compliant with the requirements. Right, now what else? We can see the registration requirements, the procedure to be followed to obtain a TIN certificate, and then the documents to be given. So I will not go into these details. The procedure to be followed, I have just shown in this slide. The documents to be submitted, etc., to get the VAT registration. And return filings, if it's mainstream VAT, basically, yes, depending on your taxable period, whether it's a 1 month or 3 months, you'll have to be mindful with regard to the return filing requirements. So returns, okay, right, mainstream VAT, basically the return on or before last day of the end of the succeeding month after the taxable period is the date that basically you will have to file the return. Right. Now what I would do is, from here, this is the most, I think, the important aspect, basically to analyze what are the exemptions that are being removed from this current 300 list, and whether any whether any lobbying or whether any submission should be made to the relevant authorities to consider. So let's look at the exemptions that are there. So like a snapshot, removal of the key exemptions, you can see import or supply of books, right now is exempt, and after the surgery, basically this is going to become liable. Then we have supply of free or subsidized meals by an employer. Now this is a very important one. Supply of free or subsidized meals by an employer to his employees at their place of work, and transport free or subsidized rate by an employer to his employees using a motor coach between the place of resident and work place of such employee, currently exempt, and going forward this is going to be liable for VAT. And of course, import and supply of cellular or mobile phones. Right now, mobile phones are outside the VAT net, and that exemption is being removed. So if you're hoping to buy mobile phones, better buy it now before the exemption is removed. And with regard to the prawns, this exemption seems, how do I say, in the list, basically the exemption for prawns is being removed, but at the same time we have to analyze and see whether this exemption that is there for prawns, whether we can claim under a different heading in the remaining items. So fishing, etc., there's an exemption that is continuing, so whether we can continue to claim the exemption under that heading, though not as directly as prawns. Then supply of locally manufactured sugar, currently exempt, and that's going to be liable. Then we can see supply of services being receipts from reinsurance receipts. Right now, not exempt, it is exempt, and it's going to be liable. So reinsurance industry. Then import or supply of pearls, diamonds, natural, synthetic, precious, semi-precious stones, diamond powder, precious metals, metal clad with precious metals, gold coins, all that is going to be liable, right now exempt. And then locally manufactured jewelry, which is exempt now, again is going to become liable. And so that's some of the key things that I mentioned. But what I will do is now I'll take one by one and industries, and then let's do an analysis, right? So right, one of the key ones is basically the residential accommodation VAT exemption that is there. Now in many countries, you look at even countries like Singapore, New Zealand, etc., residential accommodation, the basic necessities are not within the VAT net. So this has been the case from in Sri Lanka also from 1998 to basically last October. The supply of residential accommodation, whether it is condominiums, houses, or normal apartment, has been exempt. But with effect from 1st of October last year, condominium residential accommodation was brought within the VAT net. The exemption was removed. Now what is happening is The exemption that was there for normal houses, normal say things like villas, which are not condominium properties, now that also is being removed. So in other words, going forward, supply of residential accommodation is going to be liable for VAT. Of course, that supply has to happen in the context of a business transaction or a taxable activity, then it becomes liable. But at the same time, if the supply is not a taxable, is not in the context of a taxable activity, there's a room to argue and say that that is not liable for VAT, and also taking into consideration the threshold, also a technique to see whether this will be liable. So the point that we have to keep in mind is residential accommodation is going to be liable for VAT if if the other criteria are fulfilled. So what will we see in the near future? Where companies, let's the property developers are involved in supplying the residential accommodation, say villas and the houses, which are not basically condominium units, there will be a price hike, price increase due to the VAT coming on the top line. In other words, in relation to this industry, there will not be an opportunity to claim the input VAT, because the input, the construction of these stocks would have taken place over a long period, and now it's too late to claim input VAT unless an artificial deemed input credit is given. In this industry, the VAT elimination will work as a turnover tax as a general rule. Right, let's look at education. So in case of education, books, magazines, journals, and periodicals, there was an exemption, and that exemption is going out. But however, educational services provided by any person or partnership continues to be VAT exempt. So in relation to providers of the educational services, I hope there will not be a price increase because the exemption continues. But at the same time, there is nothing to guarantee that the prices will not increase. The fees charged by the educational service providers will not increase, because the educational service per se is not impacted directly, but the other how do I say, services or other supplies that they consume in order to provide the educational services may be exposed to VAT, and because of that, their cost of service may increase, and that may work indirectly to increase the price of the educational services. So let's keep our fingers crossed to see as to how this industry will face this VAT change. Information technology, again, another important area. You can see there are many removals taking place. Computers, including computer accessories, there's exemption right now, and that is being removed. Then the locally developed software, information technology, and enabled services as prescribed, and the photosensitive semiconductor devices. Now, all these exemptions that are there are being taken out. Now, telecommunication services, when we look at, I think somewhere in 2016, telecommunication services and the telecommunication equipment were made liable somewhere in 2016, so that liability continues. And as I mentioned earlier, import or supply of cellular mobile phones, the exemption is going out, but the supply of international telecommunication services provided by external gateway operators to local telecommunication operators exemption is continuing. That exemption has not been taken out. So when it comes to tea industry, let's see what do we see here. Now, we see 2 removals and 1 retention. So what is being retained? Locally manufactured machinery used for the supply of locally manufactured machinery used for tea industry. That exemption is continuing. But tea, including green leaf, rice flour, bread, eggs, liquid milk manufactured locally, that exemption is going out, and machinery or equipment for tea or rubber industry or agricultural tractors or road tractors for trailers manufactured locally, that specific exemption is being removed. Power and energy, when you look at what do we see here? We see two removals. Energy saving bulbs and raw materials for the manufacture of energy savings bulbs is being removed, and so is the plants, machinery or accessories for renewable energy that is also being removed. Then this is the importer supplier, right? Then we have the solar panel modules, accessories or solar home module, home systems. Now that exemption is continuing. Solar panel modules, accessories or solar home system exemption is continuing. And when it comes to hydropower, locally manufactured hydropower or wind power machinery and equipment, there's a removal there. Then the locally manufactured turbines, there's a removal. That exemption is being removed. The import of machinery or equipment by the Ceylon Electricity Board or an institution which has entered into an agreement with the Ceylon Electricity Board, the exemption is being removed. And with regard to the chemical naphtha by the Ceylon Petroleum Corporation to be supplied to the Ceylon Electricity Board for the generation of electricity, there is no change. That exemption is continuing. So that is among the 50 exemptions that have been retained. Right. When it comes to agriculture, fisheries, and animal husbandry, so most of the ones are being removed. You can see import or supply of agricultural machinery and parts. Machinery is used for rice milling industry, machinery used for rice milling industry. So fruit seeds are being retained. Wheat and wheat flour exemption is retained. It's continuing. Agricultural tractors, road tractors for semi-trailers, exemption is continuing. And also the agricultural machinery, amenities, forks, fertilizer, basically the exemption is continuing. Then agricultural seeds, plants, shrimp, feed, the exemption is continuing. So you can see basically certain exemptions are going out, certain exemptions are continuing. When it comes to import or supply of machinery and equipment for manufacture of grain mixed bakery products, exemption is going out. Frozen bait, fish hooks, rods, reels, fishing, tacky, and that exemption is going out. Now again, in case of prawns, there's a separate line item called prawns, and that is being removed. But then again, I think we may have a possibility of claiming this exemption under a different heading that is there under the 50 retentions. Then we have food products made out of grains cultivated locally. So the ones that are going, all these exemptions are going out. Locally produced rice products, locally manufactured palm oil, desiccated coconut, locally manufactured coconut milk, tea, including green leaf, rubber, latex, all that are being removed. Then the locally manufactured coconut oil, cocoa fiber, grow pellets, grow bags, twist fiber, coconut husk made out of coconut waste, all that. All those exemptions are being taken out. So you can see here what we witness is 80% of the exemptions are being taken out. So that's if you count one by one, it comes close to 250 exemptions. Then again, let's see. Equipment for rubber industry, so far as such products are manufactured locally. Equipment for rubber industry, then the locally manufactured sugar, as I mentioned earlier, also it's going out. Then what is being retained, rice flour, and bread made out of locally manufactured products. Yes, basically that is going to continue. Then unprocessed agricultural, horticultural, fishing products produced locally, that exemption is continuing. Now here is basically what we have to see whether prawns will come under fishing products and whether we can claim the exemption. Then locally manufactured machinery used for tea industry, the exemption is continuing there. So these are some of the key ones that I have selected there. So basically, when we go to the Q&A session, we can look at the other items as well. So in conclusion, basically what I have to point out is, yes, there is a change that is needed for VAT to be effective. Because right now what is happening is because the exemptions, the VAT system in Sri Lanka is distorted. How it works basically when the exemptions are given at the end of the value chain, there is a loss of tax revenue to the state, but On the other hand, if the exemption is given in the value chain, somewhere in the middle of the value chain, then what happens is it's not the loss of revenue to the state, it's the other way about it. What happens is there is the cascading effect being introduced to the economy. Now, why we opted to go for tax on value addition under the name goods and services tax in 1998 and then later on VAT is because we don't want cascading impact coming from the turnover tax. So now if you have exemptions in the middle of the value chain in a VAT regime also, the cascading impact comes in because of the way it works. So it's not going to be a case of taxing the value addition in the economy. So yes, it's a positive thing to streamline the exemptions. I would say sometimes, okay, right now we have to retain 50, we have to analyze those 50 also and see whether those are needed, or maybe whether there's room to further cut down the number of exemptions. But having said that, we also have to be mindful the process that we should follow to cut down the exemptions. Ideally, it should be a how to say it should be a gradual process. But on the other hand, okay, if you are going for a how to say to eliminate the exemptions in one go, then basically there are other techniques that we should follow, other transitional provisions that we should follow to ensure in the marketplace that there will not be a sudden price increase, which would result in the consumers being affected in an adverse manner. Right. So with that, I think we can go into Q&A. Sulaiman.
Thank you. Thanks, Suresh. That was a very insightful sort of implications of this bill and how it will impact all of the major industries that are going to be removed from the exemptions. So Suresh, just before we go to the questions on the floor, there are a few coming in through the Q&A. The impact you mentioned on the transition impact, right? So if you have been exempt all this time and you're going to become liable, let's say a house, for example. So what has happened is, like you mentioned, in the case of a house, you have costed it with all of the input VAT. So let's say you have hired a contractor, he will charge you VAT. You are buying cement, he will charge you VAT. You are buying iron, he will charge you VAT. So all of that VAT, let's say the cost is 1,000 to build a house, 1,000 plus VAT of 15%. So the 1,150 is what you have taken as your cost. On the 1,150, you put a profit, let's say 200 rupees, so 1,350 is your selling price, right? Now, when they take the exemption off, that 150, you don't have credit. So on 1,350, you put another 15%. So your 1,006, you are paying about almost 25% in VAT, input plus output, right? And that is the understanding, right?
Correct. Yeah. So basically, what happens is in that transaction, the VAT rate is going to act as a turnover tax rate. Going to be a turnover tax.
A serious cascading effect. So that is where I think the suggestion, and that was there in our law prior, is where deemed input for a certain period, at least sales for the next 6 months or something, is taken into account, where there is no proper input mechanism in place as a transition provision. Given the current situation faced in the country in terms of cost of living, that is something I think we as the chamber should look at submitting. And I think Sanjay, please note these points down. I think in our submission we can look at it if it's not, if you're putting a submission through the committee to the ministry, because this will have a very significant impact on the selling price of many of these products, including, like you said, phones, and so there'll be a lot of arbitrary increasing of prices as well. On the second issue, so the exemption you mentioned in the 3 months period, right? The 50 that is remaining, the 3 months, I think it looks like an oversight. So there again, I think we'll have to bring that to the notice of the ministry, because, for example, if you take healthcare hospitals, then you'll have to start paying if it's for this 3 months only, right? Including pharmaceuticals, there's a bit of a abnormal situation. So there, it's just an amendment that you'll have to do. Otherwise, you'll have to pay that if it comes through, right?
Yeah, so it's like this basically. If the government can ensure the speaker signs off in December,
yes,
not in November, not in October, in December,
right,
and not even in January, then this repercussion will not happen. Then this gap will not occur. But
right.
if the signing off is going to happen before December, that is in November,
right,
then the formula given in the Act with regard to the operative date has to change.
Correct.
From the stage amendment.
Sure. So just moving on to the questions that have come, I think one is on this, I'll just quickly read it out. As per the proposed changes to the exemption schedule, free or subsidized meals by an employer to his employee at their place of work and transport free or at subsidized rate by an employer to his employee using a motor coach between the place of residence and the workplace of such employee will be removed. So this is mainly impact to the tourism industry, where most of the hotels are providing meals to their employees, either FOC or subsidized rates. If this is provided at FOC, companies may not record it as a part of their cost. Hence, how are they going to assess the value if such exemption is removed?
Yeah, so basically, now this is a very interesting thing. In the context, if I analyze this entire scenario, supplies between the employer and the employee, is that a taxable activity is the first scenario. So if the answer to that is yes, it's a taxable activity, it's a taxable supply provided in the taxable activity, then the answer is yes, you have to charge VAT. So and then what is the value of the supply? Then it has to be the market value there also. Right. So now the counter argument here is this a supply by the employer to the employee? For that, basically, is there room to analyze the context in which this meal is being consumed by the employee? Can we say that it's a condition of the employment? It's a condition of employment. It's not a supply. For instance, basically, I have a AC fixed in my room. Is that a supply made by the employer for me, or is it a condition of employment? At 10 o'clock, I get a cup of tea to my table. Is that a supply made by the employer to me, or is it the condition of my employment? So that's a counter argument. But at the same time, we do have many battles, as you know, basically with the Internal Department with regard to this aspect. That is why this exemption, in fact, was expressly introduced also. Now it is being taken out. I believe that we will go back to the previous scenarios.
Yeah. So in that context, to the person who asked that question, I think you probably might be, I'm just wondering whether you'd be better off, because if a caterer was giving you those meals, he would have charged you VAT if he was not a small guy, right? Or if you're buying it from some sort of restaurant. Now you get to claim that input. So your cost can actually come down if you structure it properly. So if you, if the VAT on the claim, because you would have disallowed it, okay, in this instance, it's a hotel, right? So the hotel would have probably disallowed that amount of exemption. Now you can claim it to prepare all of those meals. So yeah, it depends on what the input is. So meals generally consist of a lot of exempt stuff as well. So you look at it in the context of the exemptions being removed, and you'll save only on the labor part. So you can structure it in a way that it will probably reduce the cost also if you look at it carefully. Next question. Now those new activities, business become liable on removal of exemption. Still are required to pay only meeting. Yes, so they're asking on only if you meet the VAT threshold. So only if you meet the VAT threshold of 80 million will you be liable. Otherwise, you'll continue to be an unregistered person, not charging VAT on your own. On the point of registration, Suresh, now the registration criteria is if you anticipate that in the coming 12 months you are going to exceed the threshold, you can apply. Can someone immediately apply right now on the basis that this gets passed and start claiming input just to avoid any additional cost on input building up from today onwards, for example?
Yeah, it's an interesting question because in fact I was considering this also. So basically, now The law provides basically if you anticipate that you will be liable in the future to get the registration. But the Department of Inland Revenue is not looking at that aspect of the law. Only if you have actually go above the threshold, if you become liable, they give the registration. This is not what is in the law. So it is in that context that we have to analyze here. But at the same time, now statutorily you are going to become liable. But at the same time, whether you will have that threshold criteria coming in, all that, those are things that the department may look at. So can we do a voluntary registration prior to that? Is another aspect there.
Yeah, so interesting points, but since they're coming up with it early, I don't think those will be looked at if at all it is passed on an urgent basis. Another question, rather that sort of a point of view. Now, there were certain exemptions, and like you, I think, correctly mentioned, a removal of a specific exemption can get captured in another very generic area. For example, like you said, prawns. Similarly, I think green leaf may also fall into that, because although green leaf had a specific exemption, it is removed. Now agricultural produce may sort of capture that. So I think just a warning, be careful what you take on. Make sure you thoroughly analyze the whole of the exemption schedule to see if you fall anywhere else, because there appear to be certain repeaters. So the classic example is prawns, which was specifically exempt. Now it's being exemption removed. But prawns being an agricultural produce in fisheries or something to that extent could cover it. Same with green leaf, right? So for example, coconut is not there anywhere. So coconut generally falls, the pure coconut falls within agricultural produce again, right? So that is one thing. And there is another exemption that we need to be mindful of is the special commodity levy, right? So anything that's liable to the special commodity levy has an exemption on VAT on import point. So even though certain exemptions have been removed, if special commodity levy is applied on it, the VAT exemption also comes in. So for example, I think sugar might fall, or the sugar is removed. Sugar may fall within that because I think SCL is paid on it. So you need to be a little careful to analyze this carefully from various angles to see whether you're really exempt or liable. And I think another question, yeah, subsidized meals was covered. Please mention the VAT liability for imported textiles, which are presently charged cess at the import point of imports and locally manufactured textiles. I didn't see an exemption for it. So likely to be liable, I think you have to go through the list and check that out, right? If someone is not registered for VAT at the time of getting enacted, what would be the impact if the VAT amendment enacted in between October in the case of imports? If someone is not registered at the time of getting enacted, what would be the impact if the VAT amendment is enacted between October on imports? So imports, I think imports, you don't have to be registered to be liable for imports, right? Customs will collect it on your behalf and it becomes a cost. The question is the input. So if you're not registered, by the time it comes, you can't claim it. But on that, Suresh, if you take the dates, the custom date, within 2 years, you can claim it, right? So even though you're not registered, you can claim it upon registration, I suppose, within that 2 year, because Castex, you don't need a specific format like a tax invoice.
Yeah, Castex basically, yes. I think basically there's enough room to argue to say that basically you can use the Castex that have been issued even prior to the registration, because you have the what you call the document that you need
Correct.
to claim the input.
Correct. There is no different format. I don't think. On the top of my head, it looks okay. Right. Yeah, so VAT exemption applicable for pharmaceuticals and export revenue. So basically, yeah, pharmaceuticals, the exemption will continue, but exports, the zero rating will continue. So you don't have anything to do with zero rating, will continue as it is. There is no amendment to the zero rating. So for example, services of foreign currency, export of goods, international transportation, anything to do with international transportation like freight forwarding, shipping, all of those that come within that gazette, all of those are not going to get affected by the change in the exempt schedule, right? So you need to first understand what you are, whether you are liable at the standard rate, liable at the zero rate, or exempt. Those are three categories in the VAT law. So you need to see where you fall. The people who are getting affected on this amendment is only those who are exempt, not the zero rated category or not those who are liable at 15% already.
With regard to pharmaceuticals exemption, and there is a small change when they are included, but so it treats basically pharmaceutical products, drugs, other than cosmetics,
Yes.
end use of which are confined to the therapeutic or prophylactic effect and purchased on a prescription of a physician, which was not there earlier. The use of which are confined to therapeutical or prophylactic effect and purchased on a prescription of a physician. So that's a new addition that is there.
So that has come, it requires the prescription. No, I don't know how they're going to monitor it though. So there'll be a list, is it? If you go on a list, is it? So they'll go on a list and look at whether your schedule has it or not, is what they'll, so you'll put the pharmaceutical name in your VAT schedule as well.
Yeah.
And then have audit of the prescriptions.
Yeah.
So rather impractical in my view, but yeah, that's how it is worded, I suppose. Right. So from the questions point of view, I think we have finished most. I think we're out of time also. We were supposed to finish at 4:30. So I'd like to take this opportunity to thank Suresh for taking the time to prepare these slides. It's not easy. It's a very tough area going through the VAT law, and then all of these exemptions are not straightforward. You have to go through, I think it's 14 amendments, Suresh, in the VAT law to see what is 14 versions of the VAT law.
Correct,
to see
yeah.
what.
Yeah, plus I think what the next step would be most probably to consolidate this one and come up with the Consolidation Act.
Yeah.
And also, I expect to see the why this exemption list is being removed with the expectation, two things. I think the government is basically expecting by removing these exemptions, there will be additional revenue that will come. But from a theory point, basically, removal of the exemption helps to make the VAT effective, to be efficient, to ensure basically it's a value addition that is being taxed. Now, if the idea is to ensure that the value addition that is being taxed, it's not only the list of exemptions, coupled with that, we should also revisit the list that is there under section 22, the restrictions with regard to the claiming input VAT. So there are many strict restrictions that again works out basically to, how do I say, to deviate from taxing the value addition. So that section 22 should also be studied, and that should also be changed to a great extent.
Correct. So thanks once again, Suresh, and thank you to the chamber staff who put this together in very short notice, sending out the invitations, organizing it. Sanjay, thanks for all the contribution. And over to you, Sanjay, we can conclude.
Yeah, thank you everyone for joining in, and thank you, Sulaiman, thank you, Suresh, for this webinar. It's very insightful. Yes, that's it. Thank you.
Thank you.
Okay, thank you, everybody.